Welcome back to Mark Carney's book club. This is the third and hopefully final part of chapter 15, which is the second last chapter in this book, and it's called Investing for Values. We're talking about ESG and how ESG metrics are being brought into reporting for shareholders, stakeholders, everyone interested in how a corporation is doing. They want to know more than just financial factors. We're looking at the different approaches to apply ESG factors. We already went through the ratings-based approach in part 2, which is where ESG data providers give a rating on a company, but there's inconsistencies with how they all report, and some of the data that is reported by the companies is self-reported, not verified. So there's certain issues with that. The second approach we're looking at is the fundamental value approach, where data is collected from publicly available information and it's using a shared value approach, which concentrates on a subset of broader ESG factors specific to a company's purpose and strategy. The third method is impact assessments, which measure and report the wider impacts on society while targeting specific positive social impacts alongside financial return. There's a growing list of social factors that were once not material, but which have rapidly become so. Think about the intense scrutiny of companies' efforts to increase diversity and inclusion. As the acting SEC chair, Alison Heron-Lee, observed, that supposed distinction between what's good and what's profitable, between what's environmentally sustainable and what's sustainable economically, and between acting in the pursuit of the public interest and acting to maximize the bottom line is increasingly diminished. As corporate and investor understanding of the connectivity between value and values evolves, integrated reporting provides a framework for companies to highlight and communicate their purpose and what they view as the drivers of value creation. So next, we're going to look at impact, monetization, and value. Impact investment strategies do more than simply incorporate ESG considerations. They are outcome-oriented, focusing on how a company's products and services advance specific impact goals, such as the Sustainable Development Goals. In doing so, impact strategies concentrate on a company's purpose, what it is trying to achieve, how it measures success, as well as on its broader impact on society. Impact strategies make investments with the intention of generating positive, measurable social and environmental impact, alongside a financial return. Impact strategies manage this double bottom line along a continuum between financial and social returns. Some trade off some of the former in pursuit of the latter, while a number of other impact managers seek to deliver financial outperformance alongside social contributions. So some impact strategies rely on impact monetization, which converts the ESG impacts to monetary values. Converting non-market outcomes into monetary values inescapably involves subjective judgment. Reasonable people can disagree, and different stakeholders will value outcomes differently. This is particularly the case when examining trade-offs involving the secular, the economy or profits, and the sacred, biological species or human lives. Monetization makes these differences transparent and provides a medium for comparability and accountability. But the more these highly subjective but seemingly precise numeric judgments are combined, the greater the risks that nuance and sensitivity could be lost, and financial optimization dominate the pursuit of the greater good. We're going to wrap up this chapter with the next few excerpts, and he's now going to bring this discussion back to the climate. Given that the transition to net zero is both an imperative of climate physics and increasingly valued by society, it is likely that sustainable and ultimately mainstream investors will focus on how well companies are positioned to manage the associated risks and opportunities. Companies and assets will increasingly be viewed through the lens of climate transition. Who is on the right and who is on the wrong side of history? With over 125 countries having net zero objectives, it is reasonable to expect that companies will publish transition plans and that the providers of capital will have to use that information to direct company engagement and to disclose how they are positioned for net zero. This will create a new cross-cutting asset class with portfolios judged by their contributions to global warming. The more rapidly investors can help portfolio companies and assets move to net zero, the lower the implied temperature rise. The climate transition is the largest investment opportunity. The potential investable universe is every company. The best targets are those developing actionable, profitable strategies to transition to net zero. Progress can be measured by the contribution of a portfolio to the warming of the planet. The economic return is enormous because this existential societal objective is not yet in the price. The social return is a future for all. To wrap this up, I'm going to read the last paragraph of this chapter to you. Investing in companies that contribute profitably to social progress and withdrawing capital from those that do not can create a virtuous cycle. It improves the welfare of customers, employees, and communities while generating growth and opportunities for people. When a social need can be tackled with a profitable business model, the magic of capitalism is unleashed, and the answers to the many deeply rooted problems we face become self-sustaining and scalable. The power of these solutions can be multiplied by national strategies for strong, sustainable, and balanced growth. The next chapter shows how. He does seem to like capitalism, right? I obviously have mixed thoughts on that as a self-identified anti-capitalist person. However, I do recognize that it would be very difficult to just completely scrap capitalism and start from scratch. He can put out a very good plan to transition to make capitalism actually work for us. I could potentially get on board, and it actually might make me feel less hopeless about the world. So we will see if he does that in the next chapter. Stay tuned for chapter 16. It is a very, very long one. It's like double the length of any other chapter. It's called How Canada Can Build Value for All. Lots of good stuff in there, and that will be coming up next. So stay tuned and let me know what you think so far.